It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
And welcome back to another episode of the Real Estate Breakfast for 2023, available every morning on iHeartRadio, Spotify and Apple, and of course, wherever you get your good podcast from. Well, we are back with our mortgage talk, and the current interest rate environment. As we know, it's incredibly challenging at the moment. Australia's cash rate has risen 12 times from 0.10 back in April to now 4.10 in June, an increase of 4%. The RBA, of course, is remaining steadfast to its inflationary target to ensure inflation does not become entrenched, and the likelihood is that there is going to be more pain before some of the sunshine on the horizon starts to peek its head through. And back with us, we have Anthony Landahl. He is the Managing Director of Equilibria Finance, because finance and mortgage brokers across the country are helping mortgage holders through this very testing and unprecedented period of time. Now, Anthony, there are mortgage holders hurting right now. We know that the impact on existing mortgage holders with these 12 rate rises is an ongoing thing, yet they are being asked to dig deeper and push through this period of time.
They are, and you're spot on. It is unprecedented in one sense around the rapidity of the rate rises. It's an increase of 4% over essentially a 12-month period, and the rubber's starting to hit the road. A lot of buffers around redraw and offset accounts are now being into, and the impact on cost of living is really starting to hurt people. For example, a borrower with a $500,000 home loan with 25 years remaining would have been paying around about 2.19% back in April 22. Their current rate might now be 6.19% if they've done nothing, which is an additional $1,127 a month. That's close to $15,000 per annum in additional repayments. And for those on fixed rates, that's coming. If they haven't already come off the fixed rate, it's 4% difference at June 23, and we've got some 880,000 Australians coming off fixed rates over the next 6 to 12 months, and they're going to be in a similar situation.
Yeah, so at the start, I was talking about all of this data that is available, and of course, there's no reason why people can't do their due diligence. Just having a look at the variable rate and the fixed rate, do you think there's some complacency with some people when they look at what they're paying, where somebody just might not be fully up to speed with what is about to emerge, especially around variable rates?
Yeah, it's a really good observation, Craig, and it's one we are seeing where I think coming out of COVID, a lot of people on variable rates had built up some good savings. They had a lot in redraw. And while the rates did go up, there was a little bit of a buffer there in terms of probably buffering some of that pain because they had the extra cash around in redraw or in offset that was offsetting some of those interest increases. A lot of that's now been eaten into. And just the last 6 to 8 weeks, we're having a lot more conversations with variable rate holders who really haven't done much so far on their interest rates. They've just let it roll along. And I think with fixed rates, a lot of people have said, look, I'm still paying around about 2%. And until their rate actually comes off, they don't really fully understand the impact of it. Again, the last month or so, I've just noticed people saying, hey, my fixed rate's coming off in October or November. We're starting to be concerned about what that's going to look like for us as a family.
It's probably just sort of catching up with where things are at right now in terms of the timeline, because there's been a lot of time to actually adjust to think about it rather than leave it for last minute thinking.
Yeah, and monetary policy tends to have a lag, especially coming out of the period we did where people had good savings buffers. I think what caught people a little bit is the sheer rapidity of the increase. And it has taken everyone a little bit of time to really understand the impact on what their repayments are, especially with some of those buffers and fixed rates in place over the last 6 months or so.
Yeah, so some really good points, because there's a lot of things for mortgage holders to consider, and a mortgage broker like yourself, Anthony, is constantly pivoting. I mean, you're trying to stay ahead of that curve. So what are you telling those on a fixed and variable rate to be aware of right now?
We're right in the middle of this at the moment with our existing clients and with other mortgage holders approaching us. And fundamentally, for a variable rate holder, the sort of guidance we're giving is, number one, call your bank or request your mortgage broker to call your bank and ask for a better rate. Simple stuff. And we're doing a lot of that on behalf of our existing clients. Secondly, once you get that offer from your existing bank, review this against the market. If you haven't got a mortgage broker, you can jump on some of those websites available. If you have got a mortgage broker, discuss with the broker what other offers are available in the market that you might be able to secure. We are finding some banks are offering some better new-to-bank type rates. There are some cashbacks which are phasing out, and rightly so. And there's also some consideration for people to fix, but really focusing on what's the best rate you can get. There is the odd occasion where people are unable to secure a better rate because they become what's called a sort of a mortgage prisoner because of serviceability buffers, but still focusing on your current provider and do what you can. For those on a fixed rate, Craig, just to move to that briefly, what we're really focusing on, what is the impact going to be when you come off your fixed rate? So we look at what the impact will be at that point in time. And then at that point in time, the first thing we do is similarly go to the existing provider and secure the best rate we can for our clients or for people talking to us. Then again, follow that process, compare that to the market, see if there's better options out there. And if they are, use the opportunity and the time to refinance to a better rate if you're in a position to. If you're not in a position to, because you're unable to service or your situation's changed, focus on your budget, your repayments, and getting the best deal you can with your existing provider.
And dare I say it, there is probably more pain to come. I mean, this is the worst part, isn't it? Here we are in June and we're still talking about more pain.
I think you're spot on. I think with where inflation's sitting, I think with other external pressures, with cost of living pressures and some of the wages policies coming in, we've probably got one or two more interest rate rises, 25, 50 basis points to come before the end of the calendar year, which makes what we're talking about and some of the things people should be thinking about even more important.
All right, as always, there's plenty to think about there. Anthony, thanks so much once again for coming on to the Real Estate Breakfast this morning. Enjoy your Friday and have a fantastic weekend.
Thanks very much, Craig. Great to be here.
We connect you to the best real estate information across Australia. The Real Estate Podcast.